It's a scary thing when virtually every risk asset on the planet underperforms gold. The last time we had a significant year like that was in 2008, when it really mattered. We all knew what happened in 2008.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Greetings and welcome to our Wealthion show. My name is Trey Reik, and we're here today with Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. And for those lucky enough to be able to afford Bloomberg on an ongoing basis, we've gotten to know Mike's commentary as especially insightful, and we thank him for taking the time to spend some time with us today.
Well, thanks for having me, Trey. I'm looking forward to being on. Looking forward to our conversation.
Terrific. So jumping right into things, for those not familiar with your work, can you just give me a couple of brief sketches of your team and what you're trying to accomplish?
Well, we have a decent commodity team here of energy, agriculture, and metals. Metals mostly based in London, energy all over the place, and agriculture mostly in the US, but global. But I'm the main commodity broad macro person. I spoke about the whole broad commodity market, and Bloomberg has quite the team. And for me, bottom line, as you mentioned, the terminal, I have the advantage of sitting in front of this fire hose of wealth of information and just trying to drink it every day. That's what we say here, is trying to drink from a fire hose.
Terrific. Well, for those, again, who aren't familiar with your work, I thought we would start with sort of a report card from 2025. So back on January 15th, your team published a report that was entitled 7 Metals and Mining Predictions for 2025. So again, to establish your credentials loosely with our viewers, the first two were gold will outperform stocks and silver will outperform gold. Why were you confident of those, and how did those two predictions work out?
So that was the Bloomberg Metals team in London published that. They piggybacked on my outlook on gold, and that's really their research. My research was gold was going to outperform everything on a risk-adjusted basis. It has. Silver basically trades double the volatility of gold, and it's on year to date. It's up 60%, and gold's up 50%. So risk-adjusted, silver should be up 100%. But of course, it got to that new high, and that's all it did. But my bias remained back of gold. Everything I saw was that all markets were getting stretched. We had almost a perfect storm for gold. I think gold just absolutely loves our new president, and pushing back on the Fed and tariffs and kind of disrupting the world order. In addition, we have major geopolitical things keeping the gold market quite bid. The continuing war in Ukraine, and obviously other wars going on. But to me, it's also the bottom line I saw for gold is the U.S. stock market just getting historically incredibly expensive, and it's actually historically incredibly more expensive now. And gold's been kind of the offset on that. So I think the thing is, for gold, it reached a pretty significant threshold around $4,000 an ounce. That was as far as looking at relative to virtually every moving average. I had to use 40, 50, or 60 month, 200-day, whatever one you want to use. It's basically the most stretched it has been since the late 1980s. And so I think it's reached a pretty good plateau. So for next year, I'm quite concerned with gold signaling. Certainly in a year with gold going up and crude oil going down, and that disparity being the greatest in history. Okay, we only go back 100 years, but crude oil didn't really matter 100 years ago, is quite scary from my standpoint, from what I see what it might mean.
Going back to the team predictions, 3 and 4 had to do with iron ore prices going lower and mined copper supply jumping 2%. Are those in your bailiwick, or am I confronting you with your colleagues' work?
It's mostly, it's both. I look at iron ore, let them dig into more. I mostly focus on the macro, most actively traded futures. Anything that's in the Bloomberg Commodity Index or S&P GSCI is kind of my focus. My background really is futures, starting in the Chicago trading pits in the 80s. Thing about iron ore has been a great indication of the lack of economic demand pull out of China. It's been flat for a couple of years now. And it's some of the other metals I don't dig in as deep. For instance, aluminum, but copper I do, and my colleagues do mostly the supply demand analysis and outlooks, and it turns out what happened this year is copper's obviously had a major issue with curtailed of supply, production issues. Now that's boosted up, so it's basically up for the wrong reasons. But I love to look at copper as a macroeconomic indicator. And looking forward, I look at copper at about $5.16. Watching the U.S. price, because this has really been the center of the universe because of U.S. tariffs, is at risk of going to 4 rather than sustaining and going back above 6 and getting towards 6 and reaching all-time highs. So my outlook for copper is I'm quite concerned. But one thing that's happened recently, we just reached the highest gold to copper ratio in history, and oftentimes that those peaks, which looks like it's rolling over, can be quite disconcerting. It can mean certain things, sort of global economic issues. Also, we had a pretty high gold versus everything ratio reached earlier this year and just this month in October, most notably versus silver, versus crude oil, versus broad commodities. The only thing that gold is cheap against was the stock market, U.S. stock market.
Terrific. So you continue to jump forward to the present, which is your job. I'm still trying to sort of set this up a little bit. We'll abandon the other 3, cobalt, aluminum, and steel prices, because I don't think that's really in your bailiwick. Obviously, your forecasts for this year turned out to be pretty prescient. So after rising 27% last year, gold peaked on 10/20 at 43.81, up another 67%. And on the silver side of the equation, after rising 21.5% in 24, spot silver peaked at 54.48 on 10/17, up a stunning 89%. So after those moves in 2024, and given your enthusiasm for the sector, were you surprised by the degree of the outperformance?
Oh, sure. Absolutely surprised, but nice to be on board that one. I get a lot wrong, but let's remember, and that, again, I think you appreciate you pointed it out, is my job is always look forward to have a view about where things are going. So I always try to dispel about a little bit where they went. But the key thing, a lot of my longtime listeners and viewers and people who read me on the research is I had to get beat up by gold for about 4 years. When I first traded up to 2000 and 2020, and then when we had Russia's invasion in Ukraine in 2022, I've been looking for it to go above 2000 for 20, 21, 22, and 23. So I had to be called an idiot for quite a while. Hey, McGlone, why isn't it going up? And then finally it caught up. But it caught up at such a velocity, such an extreme. Now it just, that's the lessons of the entire business. When you can take profits and you get the right side of a trade, you're supposed to do that. And I don't give investment advice, but gold is very much, to me, at reaching $4,000 an ounce is so stretched historically. Yeah, I get all the fundamentals, but sometimes you have to shift over to them being a risk manager. And risk manager, it's just so stretched versus all extremes. And I think the quote I heard was 3 to 4 standard deviations versus its 60-month moving average, which is 0.01 probability, which happens like very rarely, that you have to be lightening up and not expect outperformance from these levels. So I look at gold as very similar to what I looked at Bitcoin last year. Bitcoin reached 100,000 and the whole crypto market, it's languished since. That was since December 6th, and it's up only 15%. It's just trading like the stock market. Now gold, I think it's stuck for quite a while, and it's waiting for its next big catalyst. And I think the next big catalyst for gold might be some little deflation, a little bit of normalization in risk assets. And that's what I'm really concerned about this year. When all risk assets, most notably the stock market and cryptos and copper and virtually everything, underperforms the rock, something's wrong. And that's what I'm concerned about looking forward, is what it means.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
So again, bringing this along chronologically, you mentioned the 4 years, and that dovetails into an admission that I make, which is I've been doing this for sort of 25 years, and there are 3, I call them the big 3 fundamentals, which folks who are exposed to the precious metal trade or slightly bearish or concerned about the Fed, the big 3 fundamentals are U.S. deficit, anti-dollar sentiment, and declining Fed credibility. Now, as you mentioned, the 4 years that you were looking for these fundamentals, I've been most folks have following the gold trade have been looking for these for 20 years. So it's not that they're new. It's not that they're unprecedented. And again, this may not be specifically your area, but would you agree that these three fundamentals have hit inflection points clearly that are starting to matter on the global stage?
Oh, sure. But the thing is, the questions that are saying the answers have changed. The 10 on a 1 to 10 scale for everything that matters on everything right now is the U.S. stock market. Unfortunately, it's wonderful. It's become the economy. It's 2.3, almost 2.4 times GDP. It's the highest in history. That's surpassed what it was in 1929. Surpassed the Japanese stock market in 1989, and that's also it's also the highest ever in market cap versus the rest of the world. This is unprecedented, lofty valuation levels. So at some point, you have to shift the narrative over to what matters now. And that's what I've been doing for certain markets since I stayed bearish crude oil, and the answers have changed. And that's why I point out that's all that matters. So to get normal and continued appreciation in any risk assets, most notably copper, to have any type of base formation in crude oil, you need the stock market to keep going up. And at some point, it's going to go down. Questions when. We don't know when. I've been wrong on that for a while. So the bottom line is I think gold's telling us there's lofty issues with all risk assets, most notably U.S. stock market. And all the other things partly is, like you mentioned, increase in U.S. deficit despite expanding economy. And that's a problem. And, inflation above targets. But then also what's really changed is Mr. Trump pushing back on the Fed. Every time he speaks, gold loves him. I think that's what changed. But markets front run events and fundamentals, yes, are all bullish for gold, but the market's already priced in a lot of that by getting, the best year since 1979. You go back 100 years and still up 51% on the year as we speak on October 28th. This is the fourth best year of the last 100 years for gold. And the only three preceding one are 1979, 1972, and 1973. Massive inflationary periods. What's happening this year is gold is doing something it's never done before. It's at a parabolic rally despite stock market volatility at multi-year lows. 90-day volatility in that stock market is just very low. It's like never happened. So what is it? Is it warning us or is it feint? And we shall see. But that's part of the reason I think, when you get this kind of excessive appreciation in the store value in a short period of time, it's usually a sign of it should stall at these levels for a while. So 4,000 or even from here, a normal 30% correction is normal. I mean, that's what happened on the way up in 2006 and 2008. That's part of a decent bull market, but each time it corrected 30% from less overbought levels than we are now, according to most moving averages. So that's the key thing to remember is in markets, the answers change constantly. It's trying to keep up with those. And that to me is why I'm very concerned. I'm actually somewhat scared by what gold's been doing this year. Now, it's been nice to be on top of that trade, and I get a lot wrong. And crude oil going down, it's nice to be on top of that trade. But the main thing I've been getting wrong, Trey, and main thing is this excessive appreciation of wealth in U.S. and the lack of a decline in U.S. Treasury bond yields, which is potentially just getting started.
Terrific. So last setup question before we get to some of your recent analysis about 60-month means, et cetera. Your work obviously has a fairly strong technical component. Gold obviously has a lot of fundamental analysis attached to it. How much has precious metal strength in this recent move been driven by technicals? Do you think gold has become a technical animal?
Well, that's one thing I love about being accused of being a technician is I'm everything. I'm what matters when it matters. And right now, as I wrote about this, as soon as gold reached 4,000, I put on when it was approaching my money manager hat. I did get my FRM in 2006, financial risk manager. And I just point out fundamentals don't matter at some point when you get this stretch versus every historical mean in mankind. I can go back to the major inflation of the 70s and 80s. And that's when I switch over to the technicals. I do love getting pushback on those. That's what a money manager is supposed to do. I'm sorry, risk manager. And I just say, sorry, but this is not levels to be override bullish gold. Now, I was, for last at least 10 years, 5-6 years, just gold is the one to be in. But now it's just times to be focus on things that give you indications you should be careful. And the key thing is there's always a reason for movements. And fundamentals always matter, but there's time to be more technical, more fundamental. And this is where one thing I will point out is that there's sometimes you get great signals either way. And the gold signal we got until right about August, where it popped up to that high in April. It stuck around just 3,000. Bumped up around 3,500 for 5 months. That was like the perfect bull flag. Now that one is a great signal. I love writing about it, and I said, yeah, it's going to just pop up to 4,000. But now we got to 4,000. What do you do next? So sometimes you get technical, sometimes you get funnels, but that's part of my job is to identify what matters, and also to be above the curve and ahead of the curve and outside the consensus. When I just say consensus things, why bother to publish it? It's news. I need to be a strategist and look ahead and out and look beyond some of them. And that's the key thing I love about some of the fundamentals, like supply and demand fundamentals for copper are basically what you see in the price on the screen. What's going to be the next thing to make that move, that market move?
So this is a perfect segue. In your recent work, which I have read, you talk about spot gold's price premium to its 60-month mean, which you mentioned hit 92% on October 17th. Why is the 60-month mean significant to you in your work, and how do current gold and silver price premiums stand versus prior cycle extremes?
So it's not just 60 month, it's 40, 50 month, 200 day, 200 week, 100 week. They're all somewhat subjective. They're all, you can test, I beta test them all, and I just use the most relevant. But in commodities, typically 5-year moving average is most standard, and 60 month is the standard. So I went to that one, but I published on all of them. I published a couple on 200 day, and just to show I'm indiscriminate. I'm the money manager sitting here and saying, yeah, this is not a level to be overweight gold. And that's also the then thing you learn to trade. When you see the pile-on trade happening into significant performance like this, it's usually a sign of what happens in bull markets. Usually make peaks on euphoria and pile-on. Now that's clearly what's happened in cryptos and Bitcoin. Now gold's a little bit early for that, but you clearly saw the pile-on and stretched level. So I just pointed, that's, like I said, I put on my risk management hat and said, this is not where you want to be buying gold. By the way, here's what happens in the last 50 to 100 years. Well, only 50 years, because since we've been off to the gold standard, when markets get this stretched. Mm-hmm. And I'm always looking for better indications. The key thing is gold's been driving everything. Now, we know all the fundamentals, central banks are buying, but central banks also have somewhat elastic. They were loading up between 2,000 and 3,000, but to overweight, to load up to 4,000 might be a little bit, we might wait a little bit. ETF buyers, after 4 years of outflows, have shifted significantly to inflows this year. Now they're curtailing a little bit, but that was a major shift they identified last year that was going to happen. But all this has happened. And this also, we've seen how controversial Mr. Trump is. That was kind of somewhat predictable. Most of us who read the books about him realized it, and then that's been wonderful. Certainly pushing back in the Fed. He wasn't shy about that. But the question is, does it get any better? And we're in the middle of a shutdown. It's an epic shutdown that no one seems to care about. That's somewhat significant. So the writing was on the wall for Bitcoin to make a high around 100,000 last year. Now it's higher, but the performance is really curtailed significantly, particularly in the broad crypto market. But I need to compare the two because they ask your average 30-something, they don't care about gold. But the thing is, for gold now, there's only 4 precious metals, and gold's been driving them all up. Now, like in May, I think it was the gold-platinum ratio that the price of platinum reached the lowest versus gold ever. Now, we only go back like 40 years, and platinum caught up. Palladium a little bit, but palladium's already had its run, and silver's caught up. Silver's obviously a little more industrial. But they all, are in the back of gold, and gold's just too stretched at these levels. So the question is, what happens to next? If it consolidates around 4,000, that would have been great. That's what Bitcoin's done. If it can do a time correction, we'll see. But typically, it has 20 to 30% corrections from these kind of moves, and we'll see what happens with the rest of the markets while they might drive it.
So where does the current premium above the 60-month mean stand versus prior cycle extremes?
Still historic.
Okay.
I can pull my charts back. It's still historic. It's like 85% or so. And the peak in 81 was about that. The peak in 2006 was that, about 2008. And then 2011 was a little bit less. 2011 is significant because that's when it put its all-time high around 19,000. And then that lasts for 10 years.
But
these things happen.
You're saying even in the late 70s, it's never been more extreme than today.
Not against the 60-month moving average, no. Mm-hmm. Well, not until recently. It's pulled back a little bit, which was the point. I published that when it reached just around 4,300, and that's come back a little bit.
So now that we have the correction, if you'll call it that, from the October peak, I think through this morning's lows on an intraday basis, we're down $495 from the peak, which is about 11.3%. When you get a technical event like what we've had, does that switch the balance from fundamentals to technicals over the short run?
Well, it's still way too short, because when you go back 50 years, I'm just going back just about 20 years to 2006 and 7 and 8. Gold's had, there's periods from lesser overbought levels just we had recently. It's stagnated for years. It's corrected 30%. Is it different this time? Maybe. We'll see what's going to drive it further. So I just look at it. It doesn't, again, yes, right now, the fundamentals are known knowns. I mean, they're in the New York Times, so you can read the cover. and it's just how known it is. And that's typically where you have to be very careful loading up in bull markets. Like I said, I took the pain for many years when I thought it was going to break out. It finally did. And now's not the time to overweight longs in gold.
Got it. So in essence, even though nothing's changed in the fundamental picture, now we have these towering pivot points above us, and that will, I think, color trading in these markets for months to come. Would you agree?
Oh, sure. So the question is, what's it going to do forward? I mean, hovering around 4,000 for a few months would be a great sign of just a bull market time correction. Dropping 30%, I think, would be pretty significant buyers, maybe down to 3,500. That's just normal historically from such stretch levels. But now this is where I have to say, sometimes you have to just, when you've made a decent amount of money, if you're a strategist, you give some back to the market, sit back and wait. It's one of the hardest things for traders, investors to do is not trade or not invest and just wait for opportunities, particularly when you've been giving a gift like this. This gold rally, for those of us who've been bullish gold forever, is a complete gift. I mean, it's the best year in 100. I don't expect to live 100 years. It'd be wonderful, I do. But I don't think I'll be trading that long. So that's just how extreme. That's a key thing to mention, traders. When I can make statements like this, that we've had the most extreme disparity between rising gold and falling crude oil ever, in a year the stock market's just doesn't really care about till these lows, that's kind of strange. I mean, is this going to mean something? To me, I'm looking more at the macro. Is this going to mean something as we look back from the future? Is it telling us something? Is this warning? And I think it is. And that's where I look at the next key signal. So this is also happening with bond yields ticking lower. So when people are talking about inflation and debasing, like that doesn't usually happen with bond yields ticking lower. And then if you want to look at deflation, look at China. 10-year note yield right now, as we speak in the US, is 3.98, and China is 1.81. That's deflationary forces in the world's second largest economy. So the macro is pretty significant. Who's the largest buyer of gold on the planet? China's central bank. Largest demand pull user of copper? China. And who's the target of a lot of these tariffs in the U.S.? China.
Wealthion's putting the spotlight on silver with expert interviews, deep analysis, and a special in-depth report from our partners at SCP Resource Finance. To receive this report and other exclusive benefits, you can sign up to become an accredited investor with Wealthion at wealthion.com/accredited, or by finding the link in the description below. Speaking of silver, Wealthion will be on the ground in Toronto for the SCP Resource Finance second Global Silver Conference. Legendary investor Eric Sprott headlines the event alongside 15 silver mining companies presenting their top projects. Find out more in the description below.
So this is going to be a bit risky, but I'm going to go ahead and ask you anyway. Have you ever looked at the work of Michael Oliver?
I've heard of him, not really.
Right. So he does a lot of structural analysis, and SCP and Wealthion, we just hosted a silver conference in Toronto this past Thursday, and I was interested to be exposed to a lot of his work. And Michael has some structural ratios and spreads between gold and silver, gold and gold equities, and gold and the S&P 500. Without going into all the details, if you look at these long-term structural spreads, we're bumping up against, and we certainly were at gold's high, going through a very long-term resistance in the spread between silver and gold, between gold equities and gold in the S&P. Now, that's a lot of introduction to ask you the question, even though I think everyone agrees that gold's due to cool off a bit here. Does your work suggest that if we poke above recent highs, that there could be actually an acceleration in the move of silver versus gold and gold
So
versus the
for that,
S&P?
for that to happen, I love watching that gold-silver ratio. It was great, and it was great. It was been giving me some good signals this year when it popped above 105, when volatility in the stock market spiked with in April with the tariffs. That was a good signal. It was a bit expensive. The highest closing price in the gold-silver ratio in the history of mankind, I think, has been 90 or right around there. So we're already above that. Right now we're at 84. And then it dropped down just below 80 recently. I put out a buy signal, not so much a buy signal. Say this is good support. You're supposed to buy. And here's the key thing that's different. Volatility is extremely low in the stock market. It still is extremely low, yet it's popped up from that 78 low 80 and it's heading back higher. So that gold silver ratio is a great indicator. It goes back hundreds of years, but the world's completely changed. And what's changed is silver is less and less of a precious metal every day. It's just much more industrial. Solar panels, obviously. And gold is being hoarded by central banks more so than any other metal. People don't really hoard silver anymore in central banks. So that ratio is awesome. I think it was a great indicator. And recently I just put out, if you're going to buy the dip, I meant not the stock market, look at gold, silver, partly because it dropped below 80 and volatility in the stock market's really low. Now, gold, silver has bounced, volatility in the stock market's still very low, and the stock market's at record highs. So far I've been wrong about the stock market part, but also I do love looking this S&P 500 in terms of ounces of gold. It is the key level is about a 1.57. Right now it's 1.74. That's dipped below that a few times here and keeps bouncing up. But the first time it tested that ratio was in 1929. That's when it closed. Now that's monthly data. And every time it breaks down below it, it's been hovering on that level for a few years now, actually since 2014. So I think it's about time it's going to break down below it. But the key thing now, it's much more the stock market driving because gold's had its move. It's way parabolic. It's way expensive. Historically, you're not supposed to buy this stretch versus most moving average. You can use 60 month as an example. So now it's about the stock market can keep going up. And to me, that's the next key thing. Just now, here's what I love watching is some of the ratios are so significant. The things I'm seeing happening now is I'm so worried with the S&P 500 total return right now is 18% a year. If it's just sort of give back 5 to 8% of that, I just see crude oil ready to drop hard. I see copper had major risk of dropping, which is around 5 now, backing down, going towards 4. And then I look at bond yields, they're ticking down despite the stock market going up. Yeah, okay, the Fed's going to ease, but in this complete consensus that you got to buy the dip, stock market goes up, can't fight the Fed. Yeah, good luck with that because everybody says the same thing. You got to watch the lessons of Benjamin Disraeli. What we generally anticipate does not occur. So be very careful. So that's why I'm watching that very closely and very concerned. And the key thing I'm watching for all leading indicators are cryptos. Bloomberg Galaxy Crypto Index is up 8% in the year with the S&P 500 up 18%. That's horrible performance for something that trades 3 to 4 times the volatility. Bitcoin's up basically a little bit more than S&P 500, yet it trades 2 to 3 times the volatility. Very bad performance. So the indications for risk assets to potentially give up more of their performance versus gold will come from the risk assets now, not gold. To me, that's what I'm watching closely. And the Fed's going to ease this week. Obviously, this is not going to be played until next week, and the stock market has to go up. And that's what I'm looking at as alternatives now. Potentially are more in treasuries rather than before. It was cryptos. They were great leaders. They got too expensive with Bitcoin 100,000. Then gold was a great outperformer this year and one of the best ever, and that got too expensive. So what's left? That's why I'm looking at the risks of normal deflation from the inflation, which is the lessons of history, which is happening in China right now.
So you mentioned a little while ago that you were worried, but you speak so quickly, and I'm trying to follow everything.
I'll slow down.
I'm not sure exactly what you were worried about. So are you worried about the stock market going down, or in your world, is that a positive thing?
Oh no, it's in my world. It depends how you put it. So that's why I will slow down. The point is, it's a scary thing when virtually every risk asset on the planet underperforms gold. The last time we had a significant year like that was in 2008, when it really mattered. We all know what happened in 2008. So the signals are very bad for risk assets. Maybe finally we'll get another decline. Oh my gosh, the market's not prepared for that. We've only had 2 in the broad stock market, S&P 500, since 2008. So the market's completely given up on that. It's forgotten. And maybe gold's warning us. I find it just quite frightening what gold might be telling us, what the next big trade is. And I laid that out for you. The last big trade was Bitcoin and cryptos. No, they got too expensive. And gold has been a great trade. It's got too expensive. And I think it's telling us the next big trade might be normal deflation from inflation. So here's what happens in history. 1929 US, 1989 in Japan, 1999 in the US, 2008 in the US are all periods that are kicked into deflation only because the markets went up too much, and so deflation follows inflation. The book, The Price of Time by Edward Chancellor, points out these cycles always happen. I point out it's happening in China now. So how long can the US avoid normal deflation from inflation? And that's what I worry about when I can make a statement that gold's had the best year this year since to 1979, something is potentially wrong. Now we're going to look back from this future and say it just didn't mean anything. That's what I'm worried about. And that's why I'm concerned. Maybe there's a time you're supposed to just say, yeah, maybe it's time to lighten up on all risk assets and just stick with treasuries. And that's, to me, what gold's potentially telling us. That's my interpretation of what's happening in this year. And with crude oil going down, gold going up.
With would a 35% correction in the S&P, in your mind, be healthy for the financial system?
Well, that's the key thing. Everybody keeps saying, oh, it's a healthy correction. We've had two 50% drawdowns in the S&P 500 since 2000. Why not another one? And because when I say it, people look at me like I have three heads, like there's no way. I said the same thing in Bitcoin. Bitcoin in 2018, I said could drop to zero. I was only 70% right. It peaked around 10,000 after I said it and dropped to 3,000. Now I say the same thing. They look at me I'm an idiot. That's why I have to point out I have to be a strategist and not be biased by any positions, which I don't have. Can't trade, and not without compliance, and any not buy side or sell side. And that's why it's so important to point out these things. So I think this setup right now where we just can't stop going up is a setup for a disaster at some point, and gold is telling us that. Not so much it has to be a disaster, but we're way overdue for a normal reversion correction. The key thing is a lot of us have been wrong about that for a while, particularly recessions, but now we're at the point, the number one force for any type of recession is just a little pullback, a little bit of a reverse wealth effect, because we've had the greatest wealth effect in any time in history. It's all focused on U.S. stock market. U.S. housing market's part of it, up 57% since 2000, stock market up 100% since 2000, running 2.3 times GDP. If that just drops 20%, that's 40% of GDP. That's the most since in the 1920s and 30s. So you see the problem there? That's why it's so important. It has to stay elevated, and I think that's what gold's warning us about. And now that I'm worried about the next big trade is potentially deflation. I don't know what the trigger is going to be, but when you get risk assets this expensive, even gold this expensive, and the market completely addicted to Fed's got to ease to keep it going. The monetary stimulus has to keep it going. This is why I point out where I just listened to a book, gentleman who is 30. It's okay to be 30. I'm double that age. They point out, oh, you got to be in it for the long haul. You got to just create wealth by buy everything, keep buying. And that's the kind of things that come out in their peaks. And people just haven't learned the lesson of 1929 US, 1989 Japan.
So I was going to ask you about uranium and copper and rare earths. Do those play any sort of roles in what you're looking at?
Well, certainly copper, less so rare earths, because you have to be, it's most through equities. I have colleagues who cover those. I cover more of the underlying commodities. Uranium, less so because it's not really traded in active futures. I follow people like Eric Townsend in Macro Voices, and I believe him that uranium is going to continue to go up because of supply deficit. I don't really, but I'm not so involved with that. But copper, absolutely. Copper is in my wheelhouse, and it's been a unique trade this year. And I prefer to watch the U.S.-based copper. The European copper has just made a new all-time high, which is great, but it's based on, it's not because that usual demand pull force that, copper and Dr. Copper can show the economic, global economic expansion, is because of pretty significant supply constraints this year, production disruptions. And those are more than double normal. The questions, typically those are not, they're more temporary rather than the more enduring thing like demand pull. The key thing to watch for copper is overlay with bond yields, U.S. price, right now at 5.17 as we speak. Bond yields are going down, iron ore is going down, overlay with bond yields in China, they're going down, overlay with crude oil. Typically, these are companions with copper, and they're all going down. So what is going to keep copper up next year? That's what I look at as a wild card, and I view copper as a similar bucket as Bitcoin. Consensus is bullish. All the trends are up. It should continue to go higher. Everybody tells me the same thing. So that means the risk score goes down in there. It's very highly correlated to the US stock market. So I just wrote that recently. Copper, industrial metals, and cryptos and Bitcoin will be fine as long as the US stock market keeps going up. That's my point, is we are the most dependent in history for beta, for the tide of beta to keep going up. And there's a lot of signals that tell us that the risks are going to go down. And one of the key signals is gold this year.
So in your more recent report, I believe a few days ago, you raised a couple questions for the end of this year and next year. You've covered a lot of it, but metals beating stocks may be a trend. Did gold peak versus copper in October? Gold price headwinds, buried volatility, record-setting gold could signal a lose-lose. So we've sort of talked about the first four. Talk about the lose-lose.
Yeah, that's the key thing. I've been writing about that for 6 months. I had to rehash that because the signal from gold is what happened in 2008. It warned us, some of us, that was one of my best trading years ever when I traded, just because I saw volatility the year before got so low, it just mean reverted. But that was one signal. But the key thing from gold is when it gets this stretch, it's telling you something's wrong. So that's a potential lose. Maybe we get that normal correction in the stock market. God help us if we go down 20% and stay down 20 for a while. That's going to happen, just a question of when. And that's severe deflation because it's the highest ever in terms of market cap to GDP. And it's also typically when those kind of things happen, if it happens any kind of velocity, gold's so stretched, the first thing that happens in any type of market rug pull, you sell whatever, you sell what you can. And gold's one of those. It certainly happened in 2008. Remember, gold had a great year in 2007. It was up 30%. Got up to 1,000 in 2008. And things turned over. It dropped 30%, down from 1,000 back to 700, and then back up again. But it just because you got to sell what you got, and then you sell what you got, and not what you want. And that's why I have to tip over. The tip of the iceberg is cryptos and Bitcoin, to watch what's happening there. And the tip of the iceberg is MicroStrategy. MicroStrategy, well, now just strategy, run by Michael Saylor. I know him. I've interviewed him. We've been in touch for a while. Has rolled over. It was leading everything on the way up. It reached a pretty good peak last year, and now that stock is down. On the year, it's down. It's unchanged with Bitcoin up about 25%. So it's way underperforming. It's rolled over. 200-day moving average has rolled over. And I like to overlay that. Is you're just looking for indications. It's starting to head downward. I mean, that's the high beta stock tilting downward. And it also there's so much more fundamental involved we can talk about later. But at the same time, you look at the benchmark measure of U.S. Treasury bond prices in the U.S. That's the US 1 bond future. I started in that trading pit in 1980. It's starting to tick back up. That's my point. It's just a little reversion in that is barely started. This is nothing so far. If we get just say a 5% drawdown in the S&P 500 that stays down for a couple days, a little pickup in 90-day volatility that just it's right now 10% right now, but just a couple days ago reached the lowest since 2020. Just a little bit of reversion and the downmost tumble. And that's what I'm seeing from crude oil going down and gold going up. And I'm just looking for all the indications. But to me, that's the tip of the iceberg of where things are heading. And there's a few times I get on a show like this and I think there's times that this is just a very scary market. And there's times you're supposed to be prudent and say, don't tempt the market gods. And this is what happens. Human nature always does. They always get too bullish and euphoric at the peaks. And this to me is much more of a peak. Later stages of a bull market, you're certainly in the cryptos, it's happening, a little bit in gold. And maybe we're reaching that maximum pain versus the potential gain in things like the Treasury bonds, which have been hated for a couple of years now.
So this has been fascinating. Thanks for your time. And I'll close with a series of questions, sort of the lightning round. Between now and the end of the year, higher or lower? Bonds?
Bond prices, I think, are potentially going to go higher with a pickup in stock market volatility.
Stocks?
Lower.
Gold?
Unched.
Silver?
Unched.
Copper?
Lower with stock market.
Michael, thanks for your time. We'll check back with you in a few months.
Thank you, Trey. I appreciate being on.
Appreciate it. Thank you very much.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.